8 million ounces. Gone in 24 hours. Not traded, not rolled over, not settled in cash. Gone. Physically removed from the vaults. And that was just one day, February 11th, 2026. A date that should be burned into the memory of every silver investor, every trader, every person who understands what physical metal actually means in this market. On that single day, COMEX registered silver dropped by 3.2 million ounces. Eligible silver lost another 4.7 million ounces. Combined withdrawal, 7.9 million ounces. Let's round it to 8 million because by the time you're watching this, more has left. 8 million ounces in 24 hours. And here's what should terrify you. Nobody is talking about it. The mainstream financial media, silent. CNBC, nothing. Bloomberg, a footnote maybe. The story that should be front page news on every financial publication in the world is being buried. And I'm going to show you why. Welcome to Finance Currency. I'm going to break down exactly what's happening in the silver market right now. Why 8 million ounces disappeared in a single day. Why February 27th is the most critical date in the silver market in nearly half a century. And why what I'm about to show you could change everything you think you know about precious metals. Stay with me. This is going to get intense. Let me give you the context first because numbers without context are meaningless. COMEX is the primary futures exchange for silver in the United States. It's where the official price of silver gets discovered. It's where billions of dollars in contracts trade every single day. And it's where physical silver is supposed to be stored to back those contracts. The key word there is supposed to. COMEX inventory is divided into two categories, registered and eligible. Registered silver is metal that has been designated for delivery. It's sitting in the vault with a tag on it that says, this can be delivered against a futures contract. It's the silver that's actually available. Eligible silver is metal that meets COMEX specifications but hasn't been offered for delivery. It's in the vault, but it belongs to someone who hasn't made it available to the market. On February 11th, registered silver broke below 100 million ounces for the first time. Let me say that again. For the first time in the modern history of this exchange, registered silver fell below the psychologically critical 100 million ounce mark. 98 million ounces remaining. But that's not the scary part. The scary part is the rate of decline. In September 2025, COMEX held approximately 200 million ounces of registered silver. By February 2026, that number had been cut in half. 50% of the registered silver inventory disappeared in 5 months. Do the math with me. 200 million in September, 98 million in February. That's 102 million ounces gone in roughly 150 days. That's an average drain rate of 680,000 ounces per day. But the drain isn't linear, it's accelerating. In the last 2 weeks alone, the daily drain rate has averaged 785,000 ounces. Some days, like February 11th, we've seen spikes to nearly 4 million ounces. At 785,000 ounces per day, by February 27th, registered silver could fall to 85 million ounces. Maybe 80 million, maybe less. Now let me tell you why February 27th matters. February 27th is first notice day for March 2026, silver futures contracts. March is what they call a primary delivery month. It's one of the big ones. It's when the largest volume of contracts come due. First notice day is when contract holders officially declare their intentions. They have 3 choices. Roll the contract forward to a future month, close the position and take cash, or stand for delivery. Stand for delivery means you're saying to the exchange, I don't want paper, I don't want promises, I don't want a settlement check, I want my silver, physical metal in my hands. And here's where the math problem becomes a crisis. Current open interest for March 2026, silver futures represent somewhere between 400 and 500 million ounces, depending on which data source you use. Let's be conservative. Let's say 400 million ounces in contracts, 85, 98 million ounces in the vault. You don't need a PhD in mathematics to see the problem. If even 25% of contract holders stand for delivery, that's 100 million ounces of demand against 85 to 98 million in supply. That's a shortfall, that's a crisis. And here's what's changed in the last 2 years. Historically, only 3 to 5% of contract holders actually stood for delivery. The system worked because almost nobody wanted the metal, they wanted price exposure, they wanted to trade, they wanted paper profits. That assumption is breaking down. January 2026, which wasn't even a primary delivery month, saw 49.4 million ounces delivered. That's 7 times the delivery volume of January 2024. 7 times in a minor month. February 2026, which is still ongoing as I record this, is showing a 98% delivery rate. 98%. Out of 19.1 million ounces of open interest, 18.7 million were called for physical delivery. In a normal futures market, that number should be in single digits. When 98% of contract holders are demanding physical metal, that's not a futures market anymore. That's a physical allocation mechanism. That's a bank run in slow motion. That's people saying, I don't trust the paper anymore. Give me what's real. And the metal is leaving. 8 million ounces in 24 hours. Not because people are selling, because people are taking. There's a difference, a massive difference, and that difference is what the mainstream media doesn't want you to understand. When silver leaves a COMEX vault, it doesn't evaporate. It goes somewhere. It goes into private hands, it goes to industrial users, it goes to refiners, it goes overseas, but it leaves the system. And once it leaves, it doesn't come back easily. On finance currency, we track this data every single day. We connect dots that nobody else is connecting. And what I'm about to show you in the next section is going to make this 8 million ounce drain look like just the beginning. Because the real story isn't just about COMEX, it's about what's happening in Shanghai, in London, in the boardrooms of companies like Samsung and Tesla, and in the strategic calculations of governments in Washington and Beijing. February 27th isn't just a deadline, it's a collision course, and you're about to see exactly what's coming. Before I show you the global picture, I need you to understand something about the mechanics of this market, because what's happening right now has never happened before. Not like this, not at this scale, not at this speed. If you're new to finance currency, hit that subscribe button and drop a like. It helps the algorithm push this content to people who need to see it. And trust me, people need to see this. Now let me explain why the delivery pattern has changed. For decades, the silver futures market operated on a simple assumption. Most traders don't want physical metal, they want exposure, they want leverage, they want to make money on price movements without ever touching an actual silver bar. This made the system efficient. A small amount of physical metal could back a large amount of paper contracts because everyone knew that almost nobody would actually demand delivery. Think of it like a bank. Banks don't keep 100% of deposits in the vault. They keep a fraction because they know that not everyone will withdraw at the same time. This is called fractional reserve, and it works until it doesn't, until people start lining up, until trust breaks down, until enough people say, I want what's mine and I want it now. That's what's happening in silver. Let me show you the data. Total COMEX silver deliveries in 2024, 203 million ounces. Total COMEX silver deliveries in 2025, 474 million ounces. That's not a 10% increase. That's not a 50% increase. That's a 133% increase in delivery demand year over year. Every single month of 2025 saw higher deliveries than the same month in 2024. Every single month. January 2024, 6.8 million ounces delivered. January 2025, 31 million ounces delivered. January 2026, 49.4 million ounces delivered. Do you see the pattern? This isn't noise. This is a trend. And the trend is accelerating. Now let me show you something even more significant. Historically, when a delivery month begins, some contract holders stand for delivery. But as the month progresses, many of them change their minds. They roll forward, they take cash, they get shaken out. By the end of the month, maybe 10-20% of the initial standing delivery requests actually get fulfilled. That pattern has reversed. For the last 2 years, almost every month has seen more contracts standing at the end of the month than at the beginning. Read that again. More contracts standing for delivery at the end of the month than at the start. That's never happened before in a sustained pattern. That means people who declare for delivery are holding firm. They're not being talked out of it. They're not being settled in cash. They're not rolling forward. They want the metal, and they're getting it. Which brings us back to February 11th and the 8 million ounce drain. That withdrawal wasn't random. It wasn't a glitch. It was the physical manifestation of this new pattern. Contract holders demanding delivery, metal leaving the vault, the system being tested in a way it's never been tested before. And here's what happens next. The drain rate is currently averaging 785,000 ounces per day. But that's an average. Some days it's higher, much higher. February 11th proved that multi-million ounce daily withdrawals are possible. If the drain rate accelerates as we approach February 27th, and there's every reason to believe it will, we could see registered inventory fall below 85 million ounces, possibly below 80 million, against 400 plus million ounces of open interest. Now, I need to address something because I always try to be balanced on this channel. Open interest is not the same as delivery demand. Open interest includes both longs and shorts. Not every long holder will stand for delivery. The system has mechanisms to discourage delivery, primary among them being the cost and logistics of actually taking possession of physical silver. But here's the counter to that counter-argument. The mechanisms that used to discourage delivery aren't working anymore. In a normal month, the exchange would raise margins. They would make it more expensive to hold a position into delivery. They would call contract holders and offer cash settlements. They would create friction. They're doing all of that now, and it's not working. January saw 7 times normal delivery volume. February is running at 98% delivery rate. The friction isn't stopping people. Why? Because something fundamental has changed in how market participants perceive risk. The risk used to be, what if I take delivery and the price drops, then I'm stuck with metal. The new risk is, what if I don't take delivery and there's no metal left, then I have nothing. That's a psychological shift. That's a paradigm change. And once it takes hold, it feeds on itself. Every ounce that leaves the vault makes the remaining inventory look more precious. Every delivery that gets fulfilled proves that delivery is possible. Every day that passes without a delivery failure builds confidence that the system can be squeezed. It's a reflexive loop, and it's accelerating. Let me give you a historical analogy. In 2022, the nickel market experienced what happens when delivery claims exceed inventory. A Chinese billionaire named Xiang Guangde, known as Big Shot, had built a massive short position in nickel. When prices spiked, he couldn't deliver. The London Metal Exchange canceled 2 days of trading. Billions in legitimate profits were erased with a keystroke. The nickel squeeze happened because more metal was owed than existed. Sound familiar? Now here's the key difference. Nickel is important. It's used in batteries and steel, but nickel isn't critical to the same degree as silver. Silver is in every solar panel, every electric vehicle, every smartphone, every semiconductor, every medical device, every missile system, every satellite. A nickel squeeze was a problem. A silver squeeze would be a systemic crisis, and we're 10 days away from finding out whether the system can hold. But COMEX isn't the only exchange bleeding silver, and what's happening overseas might be even more important than what's happening in New York. Let me show you the global picture. What I'm about to show you is the part of this story that almost nobody is covering, because the silver crisis isn't just an American problem. It's a global phenomenon, and when you see how the pieces connect, you'll understand why February 27th might matter more than any date in silver market history since 1980. Let's start with Shanghai. The Shanghai Futures Exchange is the largest commodity exchange in Asia. It's where Chinese traders buy and sell silver, gold, copper, and other metals. And it's been bleeding silver at an alarming rate. On February 8th alone, Shanghai shed 31 metric tons of silver. Total Shanghai inventory has fallen to just 318 metric tons. To put that in perspective, that's roughly 10 million ounces, 1/10 of what COMEX holds. But here's where it gets interesting. There's a billionaire trader in China named Bian Shiming. He runs a trading operation through a brokerage called Zhongkai Futures, and he has built a 450 metric ton naked short position in silver on the Shanghai Exchange. Let me translate that for you. 450 metric tons in short positions, 318 metric tons in the vault. More silver owed than exists. This is the same setup that caused the nickel squeeze in 2022. This is the same math problem that COMEX is facing, and it's happening simultaneously on both sides of the Pacific. Bian made $3 billion riding gold's rally since 2022. He started building silver shorts in late January when silver hit all-time highs above $120. After the January 30th crash, his position was up roughly $2 billion. But here's the risk. If silver turns around, if physical demand intensifies, if the squeeze happens in reverse, he can't deliver. He's naked. He doesn't have the metal. Chinese regulators have reportedly frozen his ability to add to the position. They've publicly exposed the size of his short. That's not normal. That's the government warning the market that this position exists, and this position is dangerous. Some analysts are saying this sets up a short squeeze similar to nickel, because if the market turns against him and he can't add to his shorts, the covering could send silver parabolic. And here's the connection nobody is making. Remember October 2025, when London lease rates spiked to 39%. A large portion of Shanghai's silver inventory was shipped to London during that crisis to bail out the LBMA. The London Bullion Market Association was facing its own delivery problems. They needed metal. Shanghai had metal. It got shipped. That inventory has never been replaced. Shanghai's current 318 metric ton inventory isn't low by accident. It's low because they shipped their buffer stock to London to prevent a Western delivery failure. And now Shanghai is exposed. China, the country that refines 70% of the world's silver, the country that manufactures most of the world's solar panels, the country that builds more electric vehicles than anywhere else on Earth, that China is running out of silver in its exchange system. Now let's talk about London. The LBMA is the heart of the global physical precious metals market. It's where central banks trade. It's where refiners sell. It's where the real wholesale action happens. In October 2025, silver lease rates in London spiked to 34.9%, with intraday peaks hitting 39%. Let me explain what a lease rate is. A lease rate is the cost of borrowing physical metal. If you need silver today and you don't have it, you can lease it from someone who does. You pay them a fee. That fee is the lease rate. In normal times, silver lease rates are 1 to 2%, maybe 3% in a tight market. 39% means someone was willing to pay 39% annualized just to borrow silver for a short period. That's not a market. That's desperation. That's someone saying, I need this metal right now and I'll pay anything to get it. Those lease rates have come down since October. But they haven't normalized. They're still elevated. They're still signaling that physical silver is not freely available in London. And here's the pattern. When one exchange runs low, it pulls from another. London pulled from Shanghai. COMEX pulls from wherever it can. The metal moves around, but the total supply doesn't increase. It's like three people playing musical chairs with two chairs. The music is still playing, but when it stops, someone doesn't get a seat. Now let me tell you about what the corporations are doing. Samsung, one of the largest technology companies on earth, just locked up an entire silver mine. Through a subsidiary, Samsung provided a $7 million prepayment facility to Silver Storm Mining. This deal gives Samsung exclusive rights to purchase 100% of the mine's output for 2 years. Samsung didn't go to COMEX. They didn't buy futures. They didn't trust the exchange system to deliver. They went directly to the source and locked it up. That's not trading. That's resource warfare. And Samsung isn't alone. We're seeing reports of tech companies across the semiconductor and solar industries making direct deals with mining operations, bypassing exchanges entirely, securing physical supply through private contracts. When the biggest corporations in the world stop trusting exchanges to deliver metal, that tells you everything about the state of the system. The global silver market has fractured into 3 competing regions. North America, centered on COMEX. Europe, centered on the LBMA. Asia, centered on Shanghai and India. Each region is fighting over a shrinking pool of physical metal. The exchanges are competing, the corporations are competing, the governments are competing, and the metal is flowing east. China controls 70% of global refined silver supply, and on January 1st, 2026, they added silver to their export control protocols. Think about what that means. The country that processes the most silver in the world just made it harder to get silver out at the exact moment when the rest of the world is running out. This isn't coincidence. This is strategy. And February 27th is when the strategy meets the math. But before we get to February 27th, I need to show you what happened on January 30th, because that day reveals everything about how this market actually works. January 30th, 2026, the worst day for silver in 46 years. Silver opened above $100. By the end of the day, it had crashed to $64, a 47% wipeout in hours. The biggest single-day decline since the Hunt brothers squeeze collapsed in 1980. The mainstream narrative says it was Chinese speculators. Treasury Secretary Scott Bessent publicly blamed Chinese traders, called it a speculative blow-off, said the market got ahead of itself. But I'm going to show you what actually happened, because when you understand January 30th, you'll understand exactly what to expect around February 27th. Here's the sequence of events. Silver hit an all-time high of $121 on January 29th. The rally had been parabolic, unprecedented, driven by a combination of physical demand, speculative fervor, and genuine supply concerns. Then CME Group acted. CME Group, which owns COMEX, hiked margin requirements twice in 4 days. But they didn't just raise margins to a fixed dollar amount. They switched to percentage-based margins, 9% of contract value. Here's why that matters. When margins are a fixed dollar amount, you know your costs. You can plan, you can manage. When margins are percentage-based, they rise automatically as the price rises. The higher silver goes, the more margin you need. The more margin you need, the more capital you have to post. And if you can't post it, your position gets liquidated. It becomes a self-reinforcing liquidation machine. Higher prices, higher margin calls, forced selling, lower prices. But then lower prices reduce the margin requirement, which should stabilize things, right? Wrong. Because the damage was already done. The forced liquidations triggered stop losses. The stop losses triggered more selling. The selling triggered panic. And the panic triggered a cascade. Silver fell from $121 to $64 in hours. Now here's what Treasury Secretary Bessent didn't mention. At the exact bottom of the crash, at the moment of maximum panic, when blood was running in the streets and retail traders were getting wiped out, JP Morgan stood for delivery 633 contracts at a settlement price of $78. That's 3.165 million ounces of physical silver that JP Morgan took delivery of at the exact moment everyone else was selling. Let me remind you who JP Morgan is. In 2020, JP Morgan paid a $920 million fine for manipulating precious metals markets. It was the largest penalty in CFTC history. They admitted to spoofing, to placing fake orders to manipulate prices, to deceiving the market for years. And here they are, in 2026, taking maximum delivery at the exact bottom of the worst crash in 46 years. Coincidence? I don't think so. But it gets worse. Here's a technical detail that most analysts missed. Silver's implied volatility index fell 10.6% on January 30th, during a 20% crash. Let me explain why that's backwards. Implied volatility measures how much movement traders expect. When a market crashes, traders rush to buy protection. They buy options. They hedge. That increased demand for protection drives implied volatility up. In a real panic, implied volatility explodes. It doesn't fall. When implied volatility falls during a crash, it means the selling is coordinated. It means positions are being unwound in an orderly fashion by people who knew it was coming. It means the panic is engineered, not organic. This wasn't a speculative blow-off. This was a controlled demolition. And China responded very differently than the United States. Within days of the crash, China suspended 5 commodity funds. including their only public silver futures fund. They shut down 6 trading entities. They reprimanded 249 traders for naked short-selling activity. China took real regulatory action against manipulation. The U.S. CFTC? Silence. The same agency that fined JP Morgan $920 million for manipulation said absolutely nothing when prices crashed 47% in one day with all the fingerprints of manipulation visible in the data. I'm not here to tell you what to think. I'm here to show you the data. And the data shows coordinated activity. The data shows intervention. The data shows that the paper market can be controlled when it serves certain interests. But here's what the January 30th crash also showed. It didn't work. The crash was supposed to scare people out of demanding delivery. It was supposed to break the physical bid. It was supposed to make traders say, this is too volatile. I'll take cash. I'll roll forward. I won't demand metal. That's not what happened. On January 30th, during the worst sell-off in nearly half a century, physical silver still left the COMEX vaults. 3.3 million ounces walked out the door while the price was crashing. The paper price collapsed. The physical metal kept moving. That disconnect is everything. It tells you that there's a market beneath the market, a physical reality beneath the paper fiction, and that physical reality doesn't care about margin calls or liquidation cascades or Treasury Secretary statements. Physical silver kept leaving the vaults during the crash. January still saw 7 times normal delivery volume. February is running at 98% delivery rate. March open interest is still 400 plus million ounces against declining inventory. The crash didn't fix the supply problem. It didn't scare away the physical demand. It didn't reset the system. All it did was shake out the weak hands and concentrate the remaining supply in fewer, stronger hands. Hands that won't sell, hands that are taking delivery, hands that understand what's coming on February 27th, and something else happened on January 30th that most people missed. USLV, the largest silver ETF in the world, recorded over 1,000 tons of inflows in a single day. One of the 3 largest single-day inflows in the ETF's history, at the exact bottom. Someone was buying everything being sold. Institutional money didn't panic. It accumulated. The bid didn't break. It just moved lower. And now that money is sitting on physical silver exposure, waiting for February 27th, waiting for the next act, waiting for the math problem to reach its conclusion. The January 30th crash wasn't the end of the silver story. It was just the setup. So here we are, 10 days out, maybe less by the time you watch this. February 27th, first notice day for March silver futures. The most important date in the silver market in 46 years. Let me tell you what I expect, what the data suggests, and what you need to understand about how this might unfold. First, the baseline scenario. COMEX will survive March. They have tools. They can raise margins further. They can discourage delivery through costs and friction. They can call major contract holders and negotiate cash settlements. They can invoke force majeure if necessary. I am not predicting a COMEX default, but I am telling you that the stress on this system is unlike anything we've seen before. Not in 2020, not in 2011, not ever. And what happens around February 27th will determine whether the cracks become fractures. Here's what the data tells us. Open interest for March represents 500 million ounces. Available registered silver is 85 to 98 million ounces. The ratio is 4:1 or 5.1, depending on how you count. If 25% of contracts stand for delivery, that's 100 million ounces against 85, 98 million in supply. That's a shortfall. If delivery intensity matches January and February patterns, where 50-70% of contracts are standing, we're talking about 200, 300 million ounces of demand. Against less than 100 million in supply. The system has never been tested like this. Now, here's what happens in the next 10 days. Chinese markets just closed for New Year. They're offline for the holiday. Historically, when China is closed, Western exchanges take the opportunity to move prices. The paper sellers step in when the physical buyers step out. I expect possible downward pressure on silver this week. Maybe significant, maybe not, but the pattern is well documented. But here's what happens next. Chinese markets reopen right before February 27th. The physical demand comes rushing back at the exact moment contract holders have to declare their intentions. Paper sellers who use the holiday to press prices lower will meet physical buyers who come back and see cheaper silver with even less inventory than when they left. It's a collision course. And consider what China did after January 30th. They suspended funds. They shut down entities. They reprimanded traders. They protected their access to physical silver. When Chinese markets reopen, do you think the government will let its citizens miss an opportunity to buy silver at discount prices while COMEX inventory is at historic lows? I don't think so. Now let me tell you about the scenarios. Scenario 1. The system holds. COMEX successfully discourages enough delivery. Traders roll forward. Cash settlements are accepted. March passes without a formal failure. Silver drifts lower or consolidates. This is the base case. This is what has always happened before. Scenario 2. The system strains but doesn't break. Delivery requests exceed expectations but stay below available inventory. COMEX drains significantly. Registered silver falls to 50-60 million ounces. No default, but the buffer is gone. April and May become even more dangerous. This is the likely case if current trends continue. Scenario 3. The system fractures. Delivery requests exceed available inventory. COMEX either fails to deliver or invokes force majeure. Cash settlement is forced on contract holders who wanted metal. The paper-physical disconnect becomes undeniable. This is the tail risk case. Low probability, but not zero. If scenario 3 happens, here's what you need to understand. A force majeure declaration means COMEX admits it cannot deliver silver, that the paper contract and the physical reality have permanently divorced, that the futures market is not actually a market for silver, it's a market for silver-flavored paper. Every industrial user would immediately accelerate efforts to secure physical metal outside the exchange. Every central bank would reassess their holdings. Every government stockpiling program would go into overdrive. A force majeure wouldn't end the crisis. It would intensify it. And here's something that nobody wants to talk about. The legal framework for what happens when financial institutions fail has been rewritten. Your brokerage account, your 401k, your assets held at any institution. Legally, they're not yours, you're a beneficiary. The institution is the legal owner. If that institution gets into trouble under current law, they can use your assets to stabilize themselves. It's called a bail-in. The laws that enable it are already on the books. I'm not saying this to scare you. I'm saying this because if you have 100% of your wealth inside the financial system, you need to understand what worst case actually looks like. And worst case starts with a delivery failure. Now here's the opportunity. We're in the 6th consecutive year of supply deficits. The world uses 40-50 million ounces more silver per month than is produced. The cumulative shortfall since 2021 is estimated at 820 million ounces. New mines won't save this. The development timeline is 7 to 10 years. The supply curve is locked until at least 2033. Citigroup, one of the largest banks in the world, published a note with a $150 price target for silver. That was before inventory broke below 100 million. The smart money is positioning. Samsung is locking up mines. China is restricting exports. The US government has classified silver as a critical mineral. This isn't speculation. This is superpowers fighting over a strategic resource. And you get to choose which side you're on: physical silver, allocated storage, direct mine investments, or paper contracts that may or may not be deliverable. That's your choice. My job on Finance Currency is to give you the information, to show you the data, to connect the dots that nobody else is connecting. What you do with that information is up to you, but I'll tell you what I'm doing. I'm staying stacked. I'm watching the vaults. I'm counting down to February 27th, and I'm documenting every single day of this historic moment, because 46 years from now, people will look back on this period and ask, what was it like to watch the silver market transform in real time? And I'll be able to say I was here, recording it, analyzing it, sharing it with you. If you got value from this video, subscribe to Finance Currency right now. Hit the notification bell, drop a like. Share this with one person who owns silver. Most people have no idea what's coming on February 27th. Most people don't know that 8 million ounces left the vault in 24 hours. Most people don't understand what these numbers mean. Help me get this information out and drop a comment telling me, do you think COMEX makes it through March? Physical metal, miners, or futures? What's your strategy? I'll pin the best responses. This is Finance Currency. The clock is ticking. February 27th is coming. Stay sharp, stay stacking.